What are some of the strategies that you as a sole proprietor you can take so that you can be able to avoid tax? A sole proprietor is a person who owns a business, and it is the simplest form of business ownership where the individual and the business are considered the same legal entity. So I'll be taking you through these strategies where you can be able to avoid taxes as a sole proprietor. One is the capital allowance business expense, whereby you are supposed to claim allowable deductions. Let's say, for example, you have rent that you did pay within that year, you have salaries, you have utilities, supplies, transport, etc. Let's say, for example, they are accumulated to 1.2 million. Then you have capital allowances. Capital allowances in Kenya apply to all qualifying fixed assets used in business. So here we have an example. If a sole proprietor buys a factory building worth 5 million, industrial building deduction within that year will be 10% of the cost of the building. That is 500,000 a year. Then if you have computers worth 200,000 that you purchase within that year, you'll claim what you call wear and tear under class 3. That is 30% of the cost. So that will be 60,000 for the first year. Then you have motor vehicle that you purchased within that year. So you'll claim 30%. Let's say, for example, the cost of motor vehicle is 1 million. So you'll claim 30% of that, which is 300,000. So total capital allowance will be 860 if you sum up 500,000, 60,000, 300,000. If you sum up all that, it is totaling to 860,000 as a capital allowance. So key condition to claim capital allowances. One, asset must be owned by the taxpayer. So if you are a taxpayer and you purchase that particular asset, so you must own that particular asset. Then that asset must be used to produce taxable income. Then you also need proper asset register and documentation is required for that purpose. So I'll give a simple computation. Let's say, for example, within that particular year, you generated annual revenue of 3 million. So I'll give two scenarios. The first scenario, it is where we have a strategy without tax avoidance. So that is the first scenario. And you'll find that from the first scenario, you only have allowable expense at 1.2 million. So if you deduct capital allowances, you'll get 1.8. So this 1.8 is supposed to be computed using the graduated scale, like the way we normally do for pay. Then you will find that the tax computation per individual rate, that is the graduated rate, is 447,400. Then you deduct personal relief. For that matter, you will end up paying tax which is payable is 418,600 shillings. So with another scenario is without tax avoidance, with tax avoidance strategy, sorry. So in this case, we have 3 million, then we have 1.2, which is deducted from all the expenses we mentioned, the salaries, the rent, the utilities, all that. So it amounts to 1.2. Then we have the capital allowance. Remember, now you want to avoid that, so you must take care of capital allowances. Remember, 860,000. It's a consolidation of what we said. That is factory building 500,000, computer 60,000, then motor vehicle 300,000, and that totals to 860. 860,000. Then we have the pension contribution if you contribute to a pension scheme. So you'll also deduct 240,000 per annum. Remember, you're allowed to deduct up to a maximum of 20,000 per month. Then we have mortgage interest deduction. That is 300,000. We are assuming that this particular person or a business person acquired a mortgage so that for the purpose of building his house. So interest that mortgage interests are deductible for the purpose of arriving at the taxable income. So in this case, you find that the taxable income is 400,000. So there is a difference because the first strategy where the businessman is not taking advantage of capital allowance, pension contribution, and mortgage. So that particular person is ending up with a taxable income of 100, but in this case, he is ending up with a taxable income of 400,000. So tax computation using the graduated scale, it will be 57,400. So if he less personal relief, 28,800, which is for a per annum. Then if you less insurance relief, we assume that this particular person paid insurance relief of 50,000. So we'll end up with 21,100. So you'll find that the tax payable between the two strategies, the difference of the tax saving is 397,500. So this is what I'm talking about. 397,500. So this particular sole proprietor or business person will be able to save on this. So guys, let's take advantage of tax allowable, how we can be able to avoid taxes. And in this case, if you take this, it will be of great help and you'll be able to avoid tax, which is legal according to Income Tax Act, Cap 470 of the laws of the land. Also, you'll find that there are, according to Income Tax Act, Cap 470, Section 15, allowable deduction and expense mortgage. They are under that section. Then Section 22A, we have pension contribution. Section 31, we have the insurance relief. And for the rates, you can get them under the second schedule. All the capital allowances rates, you can get them under that. Thank you.